Everyone to today's webinar, The Art of Financing Your Business, a panel discussion. My name is John Ripple, and I am an Akron Canton SCORE volunteer. And this webinar is actually being hosted by the Akron Canton SCORE. So can you change the slide? Go one more, please. Okay, so what is SCORE? So SCORE is, is a nonprofit that's actually been around since 1964. SCORE has the largest network of volunteers with a variety of business skills and experience that are shared with clients free of charge. So no matter whether you're starting a business, whether you're growing your business, or transitioning your business, SCORE will have a mentor to help you through the process. It's also been reported that the clients that receive 3+ hours of mentoring achieve higher revenues as well as increased growth. Next slide. So SCORE's mission is to help small businesses survive through mentoring and education. We aim to provide each client with the skills and support they need to succeed in their small business. Small businesses are the economic engines. They build wealth and create jobs. SCORE understands that small businesses are critical to the success of communities as well as the economy. So, next slide. So SCORE has over 10,000 volunteers across the U.S. with over 200 SCORE chapters. So SCORE offers counseling for both for-profit as well as nonprofit businesses. Next slide. So SCORE volunteers and mentors must follow a code of ethics, including not making money from clients, not using clients' data for commercial purposes, and mentoring sessions are absolutely confidential. So next slide. SCORE is a resource partner of the Small Business Administration, commonly referred to as SBA. And with the help and support from SBA and our sponsors, SCORE is able to provide free counseling to clients and put on education webinars and workshops like the one today. So next slide. So this slide shows the sponsors to the Akron Canton SCORE chapter. We have platinum sponsors that include the Hoover Foundation, the Stark Community Foundation, Stark State College, and the Akron Community Foundation, as well as Key Bank. Our gold sponsors include Huntington, the Kenneth L. Calhoun Charitable Trust. Next slide. And then we also have silver sponsors that include People's Bank, the Waldy Family Foundation, and the Gertrude F. Orr Donor Advisory Fund. And bronze sponsors include the Lehner Family Foundation, the James S. and Patricia L. Ripple Charitable Foundation or Trust. We have the Consumer National Bank and R.C. Munson and Catherine M. Munson Charitable Fund. So all the sponsors are greatly appreciated. So reach out to your local SCORE chapter. You can do that through www.score.org, or you can actually take a picture of the QR code. If you need help with any type of business challenges, feel free to reach out. Also, SCORE is continuously looking for volunteers. So if you have a willingness to give back from things that you've learned through your experiences in business, we would appreciate you reaching out to SCORE as a volunteer. So several housekeeping items before we actually get started. Number one, if you have questions during the panel discussion, there is a Q&A tab at the bottom of your screen. We would ask that you please write your questions in the Q&A tab, and if you would, avoid putting your questions in the chat tab. So we'll be monitoring the Q&A tab for any questions. Number two, if the panelists, though, have a question for you as attendees, we'd ask that you would answer the questions in the chat tab. That's how we differentiate between your questions and the questions from the panelists. Number three, there will be several poll questions that are designed to get a pulse of the people that are attending the webinar. So I would encourage you to respond to the poll questions if you would, please. Number four is that this webinar is being recorded and will be posted on the owners.Our website, and you'll be receiving a link to this recording if you'd like to be able to view it sometime later in the future. So with that, let's get started. We have four panelists today. We have Mark Hansel, we have Sean Ulick, we have Ray Graves, and we have Brian Adolph. And at this time, I'd like to turn the platform over to Mark Hansel, and he'll take over from here. So Mark, the platform is yours.
Thank you, John. Thank you very much, sir. And again, I'm Mark Hansel. I'm a SCORE mentor and subject matter expert with the Akron Canton SCORE chapter. Been with SCORE for about a year now. Prior to that, I worked for the United States Small Business Administration out of the Cleveland District Office, and enjoyed my time there quite a bit. And so there you have some brief information on me. But really, I'm going to moderate this discussion. We have three experts here. We've got Ray Graves, Sean Ulick, and Brian Adolph, and they're going to hold forth on a variety of subjects relative to financing a business. And that's really the topic for this morning's discussion, how to get something financed there. So let's see, who's up first? Sean?
Looks
Sean,
like I
you want to give your elevator speech here?
am. Sure. Good morning, everyone. My name is Sean Ulick. I am a business development officer, the Canton market manager, and the head of government financing for Consumers National Bank. I've been doing banking for over 26 years and 20 years in business loans. And so Consumers National Bank, headquartered in Minerva, Ohio, near Canton, Ohio. We are the largest headquartered community bank in Stark County. We have over 25 locations serving several markets, counties in this area. We've been named the Community Bank of the Year by the SBA in the Northeast District several times, I think 7 to be exact, Ray. And just glad to be here and share whatever knowledge that we can about helping new businesses or existing businesses gain the financing that they need.
Sounds good. Thanks, Sean. Who's up next? Ray? Raymond Graves.
Sounds like it. All right. Well, thanks, Mark. Appreciate the opportunity. And I am the lead lender relations specialist at the Cleveland District Office of the U.S. Small Business Administration. My background is pretty much all in SBA lending, sort of in and out of government. I started in 1997 in the Columbus District Office of the SBA. And then I went and moved around through a couple of certified development companies. My last role in that environment was a chief credit officer, but I've had roles as relationship manager and processing assistant, you name it. I've kind of done it on the SBA side. And then about 10 years ago, I came back to the SBA and got a role here at the Cleveland District Office, and it's been really great. We love working with small businesses. Background on SBA is just, sort of the traditional counseling, trying to assist borrowers and business owners get the information they need to be successful, and contracting and trying to link folks up with government contracts, and then credit, which is sort of my specialty in linking up borrowers and banks with the SBA programs that help unlock access to capital for business owners.
Very good. And now, Brian?
Yes. So I guess I'm the entrepreneur, the business owner of the group. I apologize, my phone's going off in the background. But I am the owner of Transworld Business Advisors of Canton. You can hear me. Can you hear me over the phone?
Yeah, you're good.
Okay. Yep. So I'm the owner of Transworld Business Advisors of Canton, which is Northeast Ohio's trusted business exit partner. We serve Stark and Columbiana counties for entrepreneurs for confidential business brokerage, certified business valuations, and strategic exit planning. We specialize in helping retiring business owners to maximize their value, preserve their legacies, and execute confidential transitions. Our certified business appraisers provide accurate valuations and succession planning for business sales and acquisition opportunities. So whether you're selling a business, doing family business planning, planning for retirement, or buying an established company, you need expert guidance. That's what my business does. I've had two businesses of my own. I've ran a marketing company and a vending company that I exited before actually getting into the banking industry, and then getting into this to help small business owners as well. So I guess my expertise on this panel is going to be in helping anybody that's either looking to grow their own business by acquisition, or that may be looking at using SBA lending for somebody that may be looking to acquire their businesses. 85% of acquisitions actually use SBA lending as well. So, and we help with that with the SBA eligibility and in acquisition lending with what we do here. So,
Thanks very much. And by the way, John Ripple, do we have any questions in the Q&A so far?
No, no, we don't.
None. Okay. Have we gotten any response to the poll questions at this point?
Well, we'll have to have Glenn put the poll questions out.
Okay, sounds good. Well, since we're talking about change of ownerships here, I know SBA does change of ownerships. I know change of ownerships can be done conventionally without the SBA. I mean, in dealing with the change of ownership, what are some of the guidelines here in financing changes of ownership? Brian?
Yep.
Sean? Hey.
So as far as what we get when people come to us, we always want to make sure that they're going to be SBA eligible for if somebody is going to be looking for an acquisition. A lot of people don't realize kind of what that qualification or eligibility means. They're assuming that it's going to be more on the buyer than the business, and it's going to be actually lent or leaning more on the cash flow of the business, the SDE, the seller's discretionary earnings, or the EBITDA of the business, which is the cash flow that the business provides. So their ability to pay back the SBA loan is more important for that eligibility for that loan than possibly who might be coming for the lending. So we look at that first. Of course, when we do find a buyer, we're going to have to make sure that that person is going to be the right fit and able to actually run that business and that it makes sense for that buyer. However, if we're going to be looking for somebody to acquire that business, we want to make sure that the business itself is going to be able to maintain a potential loan in the future.
Sean, did you want to weigh in on that?
Well, I would say we do, as a bank, we do look at the individuals that are buying it, but I would agree with Brian. You have to have a business that's actually succeeding to some point and that can service the debt that's coming in. That's your main source of repayment as a bank, is that business and the cash flow. But there has to be some kind of experience, hopefully in that industry that we look for from the individuals buying that relates to what they are buying. The other thing that we find a lot is seller notes out there. If you are using SBA, hopefully that seller realizes that they're going to have to be on standby depending on the dollar amount of the transaction, as well as we get a lot where, well, I want to stay in the business for a couple of years, or, the owner now isn't really ready to retire. He wants to sell, but yet he wants to maintain a position and a salary. SBA dictates that, I think they're allowed to be in there for 1 year. After that, they need to be removed of any part of the business. So those are some things that we look at. You know, in the banking world, there used to be 5 C's of credit. Well, now it's cash flow, cash flow and collateral, and then cash flow again. So that's to Brian's point, is cash flow of the existing business is very important. I think another thing that surprises a lot of people is depending on the dollar amount that we want a business evaluation, knowing that what you're buying is actually worth what it is. Because in a lot of cases, when you're selling a business, a lot of that is goodwill, right? There's not any what we call hard collateral that backs it up. You know, hopefully maybe there's real estate that always helps out. Equipment always helps out. Stuff that we can, as a bank, get our hands on if we needed to. But in the end of the day, a lot of it's all dependent on a multi-factor of, you know, the EBITDA. And that usually ends up in a big, what we call airball, meaning there's nothing backing it. So a business evaluation is very important to get as well.
Yeah, you know, you brought up the subject of EBITDA, and just what exactly is that? Where do you find it?
Well, EBITDA, you know, basically that's your earnings
Before
your
interest,
taxes and
taxes,
depreciation and
depreciation, amortization.
amortization. What I usually tell people, just to kind of break it down, is take a look at the company's net income and then add back depreciation expense, amortization expense, any interest, any one-time expenses, or maybe even the owner's salary that is going away. Maybe the new owner's not going to take that much of a salary. You add all those back in, divide basically that number by what your annual payments are. And in the banking world, that's our cash flow. That's our debt service coverage ratio that we look for. And, you know, a benchmark on that for us is 1.2. So for every dollar you're spending, you're making 20 cents, or the business is.
Yeah. So what Sean's talking about is the difference in EBITDA and seller's discretionary earnings. What we like to advise somebody on is you need to picture what if somebody's going to be an owner operator, what they are going to be possibly inheriting if they were to take your job over, if they're going to be an active participant in the business. EBITDA is generally used on evaluation where somebody's going to be more of a passive investor, and that they're going to need to hire somebody to take that spot. Seller's discretionary earnings is more on the small business side, where we can add back one owner's salary, because that salary is going to be included in the expectation that person is going to be taking their role in the company, and part of their seller's discretionary earnings, because they'll have discretion over that income.
Sounds good. Ray, did you want to weigh in on change of ownerships and SBA policy?
Yeah, sure. I think that what Sean and Brian have been saying makes a lot of sense. I guess my observation would be, while many of the business acquisitions are probably SBA deals, SBA does a ton more deals than business acquisitions, right? I'm not sure whether your participants are really in the business acquisition world. Many of them might be startups. Many of them might have existing little businesses, and they just need some financing for build outs and that kind of thing. True. And I guess I would say, just overall, you know, whether it's a business acquisition or, you know, building out your Subway franchise, or, you know, starting up your beauty salon, whatever it is. The art of financing a business relates to the concepts that Brian and Sean mentioned, the ability to repay the debt, which they're, you know, using the terms EBITDA or, you know, capacity or cash flow, the ability to prove that you can pay that debt installment every month, even in your worst month, goes a long, long way to getting yourself an approval. There are some other factors as well. And when we talk about the art of financing a business, we're talking about how all the pieces fit. But the one kind of takeaway for probably most of the people in the audience is that the ability to prove that you can make that payment, you know, with a few cents to spare every single month is really the key to unlocking an approval on financing.
Sounds good.
Hey, Mark.
I see we have some questions now.
Yeah.
Let me
Yeah,
throw
Mark,
one out.
can we pause
go
this for
ahead,
a second?
John.
Let's let Gwen put up the poll question
Okay,
before
great.
we answer the questions. Gwen, can you do that? Hopefully she can. There it is. So if you would, everybody says, where are you in the business process? And if you could just indicate whether you're a startup or existing business, we appreciate it. There's a few seconds for people to respond. It looks like about 52% are startups and 48% are existing businesses. How about the second poll question, Gwen? Can you do that? So it looks like we're about 50-50 on startups and existing. Interesting. So you've been turned down for a business loan, yes or no? Mm-hmm. 12% says they have, and 88% say no, they have not. And Gwen, I think we have one more poll question, if you can put that up. So that's a good sign, right? 88% have not been turned down. I see someone put in the comments that said they haven't applied for one yet.
I'm having a little problem launching this third one.
Okay, so we can go on without that for now. Okay, there are a couple of questions. This came from an anonymous attendee. It says, are there any industries that SBA loans do not apply to? For instance, film and television production companies and media companies. Are they eligible for SBA loans?
Sure. I mean, I think I can take that. The eligibility for an SBA loan specifically would be you have to be a small company for profit and actively providing some kind of product or service. There's a lot more to it than that. So that's distilling it down. But if you basically said to yourself, hey, I'm small, I'm active, for profit, I provide a product or service, in most cases, 99% of the time, you're going to be eligible. So film, sure, as long as it's not like a not-for-profit documentary organization or something, you're going to be eligible. The biggest question, of course, is not eligibility, but really getting credit approved for the loan. A lot of times when we get that question, people say, am I eligible for a loan, as if that was the same thing as being approved. It's not. Being eligible is relatively easy unless you've got some kind of complex structure. Getting approved really means proving that you have the ability to repay the loan, proving you have the experience to operate effectively, having the right amount of collateral and the right amount of equity, and making sure that conditions are right in the market for you to have an approval at this point in time.
Interesting. Very good. Got another question related to that. It says, what's the benefit of an SBA loan versus a bank loan? It says, are there interest rates or terms more favorable than a bank loan? I think they're referring to SBA interest rates and terms more favorable than a bank loan.
If you guys want, I can take that as well. In most cases, there's sort of three different kinds of SBA loans, right? There's a microloan program, there's the 7A loan guarantee program, and then there's the 504 loan program. So depending on what you're talking about, the answer could be a little bit different. Most of the time, people are getting 7A loans, and all we're doing in the 7A model is we're insuring the loan that a Consumers National, for example, would make. So Is there necessarily a benefit as far as rate or term? You're negotiating that with the bank. So it's pretty much going to be what the bank wants to do. Now, the SBA does have some limited oversight into, the fees that a bank can charge and the maximum rate that a bank could charge, but we do not tell the banks what to do. So you're negotiating that with your lender. And in most cases, I would imagine SBA might be able to have a little bit of a longer term or a little bit longer amortization than a bank could do, probably on a conventional basis. Maybe a little bit of a larger loan size compared to what they would do on a conventional basis. Like maybe you could get 90% loan to cost rather than 80% loan to cost. So a little bit of a larger loan size. But it's not an incentive interest rate on the SBA side. It's not like we're doing, a 1% interest rate. Really, what we're doing is we're insuring a bank or a credit union making a loan, and they're going to determine what their interest rate and their cost of funds is for you. So you would negotiate that with the bank. The main benefit of the SBA is really getting to yes. It's really getting a deal that you wouldn't have otherwise been able to get.
Sean, Brian, you want to weigh in on the same subject or question?
Yeah, typically on an SBA loan, when we're doing a 7A, you're going to typically see a higher rate than your conventional. And reason being is there's fees that are incurred by the bank on an ongoing basis for that guarantee that Ray's talking about. So, for example, it's about 50 basis points of the guarantee that we get charged on an annual basis that is built into your rate. I'm just being honest and upfront of how the banks look at this. As far as terms are considered, we can go out longer. Example, equipment, typical traditional equipment loan with your bank is probably going to be around 7 years. SBA allows us to stretch that out to about 10 years, or even on real estate, owner occupied is what's eligible for SBA. We could go out to 25 years versus typically on commercial real estate, you're looking at 20 years. So there are benefits to that. And then I know Ray mentioned the 504 program. That's a great program if you're looking at real estate and maybe there's some equipment and some mixed use there. On that end, you'll typically see on the SBA's portion, what they call their debenture, their portion of that loan, you'd have a traditional loan with the bank, then you'd have a second loan with the SBA, and that rate is traditionally lower than what you're going to see at the bank, that second loan, the debenture that they're talking about. And it's also fixed for a lot longer time period than what the bank would fix it at.
Yeah. I'd say in general for we use SBA loans as it's an access, it's a tool. And a lot of times for approvals and things like that, it can be speed to approval and things like that, especially if we have half the equation already kind of matched up with the bank. If somebody's using a Rob's plan or another tool, and he mentioned also about seller financing, and if we've got other kind of things coming into play and handling where we don't need a full SBA loan to cover an acquisition or to cover an entire loan. SBA again becomes a tool in the toolbox that I think it should become a consideration, not the end all be all or go to.
Brian, you mentioned Rob's. What is that exactly?
So it's a retirement of business startups. So where somebody can take a 401k plan in order to start a business. So if somebody's leaving corporate America, they can use their funds from their 401k and use those funds for startup funding. It pairs well with an SBA loan, where they can then use for the difference. They can use the ROBS as the down payment for an SBA loan. So
sounds good.
Yep.
John, did you want to continue with the questions?
Yeah, Ken. There's one dealing with if we can have maybe a brief discussion about how to grow a business without acquiring another business. Are there financing opportunities to grow the business, whether it's buying inventory, machines, so forth.
I would say yes. That based on what you're looking to do. If it's a capital need, do you need more? I guess there's multiple questions here. That's a pretty wide open scenario.
It
It
is.
could be anything that has to deal with, do you need marketing? Do you need to add extra sales force, so employees, or is it an equipment need? You're running at a high capacity right now, and you need more, or you need to purchase inventory for orders coming in. There's ways to get that done with your bank, preferably consumers, but the lines of credit for inventory, cover receivables. SBA's allows access to working capital. So if you're looking at, you need to hire someone for marketing, accounting, there's multiple options there. I would need to understand more of what you're looking to do, to point you in the right direction on that one. But yeah, I mean, we do everything from expansion of facilities, equipment financing, lines of credit. Again, those should be covered by something like inventory that's going to be sellable. That's my answer.
There's a related question here that may tie into this, and it's from a different person. So would a bank or SBA give a loan to produce an order, and they were specific for a fashion company or a clothing company, but it could be for anybody? I guess it's in order to build inventory and get a larger order for economical lot sizes for products coming in bound to make your product. So bottom line is, with bank and SBA loan be available to support small businesses to build inventory?
Yes. The answer would be yes. And SBA does provide specific loans that we can utilize for contract manufacturing.
Ray, do you want to chime in on that?
I think the answer is yes. Yeah, if you've got, your company has work that it's trying to get done, and you need to finance purchase of raw materials so that you can turn around and convert that into sales, that's a line of credit ask, and that's a very typical use of SBA funding. In fact, our most popular sort of sub program is called SBA Express, and most of those are lines of credit. So if the audience isn't familiar with sort of the concept of a line, what we're talking about there is something like kind of like a credit card that you pull down the financing when you need it, and you pay it back right away as soon as you get the cash flow back in, and you pay interest on what you've drawn, rather than sort of like a installment payment system where you've got X amount that's due every single month. So, if you've got some kind of need like that, I would look into working with a bank that supports the SBA Express lines of credit program. It's very, very common. Those are probably a couple, maybe 1,500 deals per year in the state of Ohio alone. Very common.
Right.
Yeah, we do a lot of the SBA Express lines here. The one thing I would say is, yes, you're paying interest only on what you buy. Just make sure when you sell it, you pay down your line.
Yeah, I think
That
it's
way
really
you can
important.
what we call revolving the line, so that you have access to that capital again. So say you have a $100,000 express line, you use 75,000 for materials, you sell them at 100,000, take the 75 and pay back down your line, and then you have the 100,000 back available to you again. Banks like to see those revolve and not just sit out there.
By the way,
SBA
what's
likes
the
that too.
max on Express, maximum loan amount?
$500,000.
$500,000. John, did you have another question in the queue?
Yeah, this one is really specific to SBA loans, and it says the SBA loans supposed to help low income people, but their requirements for approval does not align with low income people. Why is that? So again, the question is SBA loans supposed to help low-income people, but the requirements for approval doesn't align with low-income people. Why is that? So I'm not really familiar with the application process, but it sounds like some of the requirements don't align with someone with low income.
Well, I think, I mean, maybe the misconception there is that SBA is a low income support mechanism, and it's really not. SBA is there to support small businesses that are trying to grow and expand. But if you're looking at SBA as a low income support mechanism, it's just not really built that way. It's not sort of targeted towards LMI borrowers in that way. It's really thinking more in terms of here's a business that can't get access to capital for some reason without support from the SBA, and they still have to have the ability to pay the loan. I guess that's all I can really say about it. It's built to kind of support small business lending, but it's not really a targeting low income people. That's a different thing.
Okay,
Ray, I think
that's all.
there might be some mission-oriented programs out there, though. I mean, through microloans.
That's true. So the non-bank lenders that we work with, that we support through not the bank support program, the 7A program, but a different program called micro lending that does focus on folks who can't get access to capital from banks or credit unions. So if that's sort of the thrust of it, I would say look into the micro lending program. Here in the state of Ohio, the micro lender is ECDI, which is the Economic and Community Development Institute. And what they really do is focus on businesses that maybe have microfinance needs, might be $1,000 to get to, that next level, so that they can become bankable. Also, folks maybe that are coming back from a deployment or folks that don't have great personal credit. We really want to build in an alternative there beyond sort of the bank financing structure. So take a look at the microloan program.
Okay, as a reminder, if you do have a question, we'd appreciate if you put it in the Q&A tab. I do see a couple questions in chat, and here's one of them. It says, what is needed when applying for a loan in a startup business? Do you need your business plan?
Yeah, for sure.
Yes.
Yep. So SBA funds, like I said, several thousand deals a year in Ohio. I would say, maybe 1 in 5 of those transactions are for new businesses. So new businesses would be, anyone from just the pure startup to a franchise operation someone's starting to potentially a business acquisition we would consider new because the entire management is changing over. So it's very, very common to use SBA backing for a new business. And that's because lenders, without our support, tend to sort of shy away from riskier transactions. And startups are risky. So having a business plan is really important. The key aspect of that as far as financing, of course, is your, really well-supported financial projections.
Sean, you were going to chime in, I think.
No, I was going to give a plug for SCORE on that one.
Okay, great. Go ahead.
When I meet with someone who's looking to start up a business and they're starting from scratch, or they have their idea, or they're looking at, like Ray said, a franchise opportunity, I highly recommend getting involved with your SCORE chapter. These are individuals that know what the banks are looking for. They know what I am looking at and what I need as the banker. They're going to look at 3 years of projections, the first year being a month to month. They're going to walk you through your business plan. And as Ray said, those projections, the common theme when you go around from bank to bank, bankers will say projections are worth the paper that they're written on, right? If you have backup to those projections, like Ray's saying, that gives us a little bit more comfort of what's going on, and that ties back to SCORE. They will be able to do that, help you with that, mentor you through it, and save you a lot of time and hassle with trying to piece together a package for your bank.
Hey, Brian, in your world, do you deal with startups?
No, unless, like I said, somebody's looking to buy a franchise, as mentioned. So we sell franchises, and we resell franchises. So if somebody's looking to buy a coffee shop that's like a Big B coffee shop, for instance, we just sold one of those that was selling to another vendor. And again, we treat that as a startup because it needs to be resold to somebody completely new that's coming into the business for the first time. But no, we do, yeah, SCORE would help somebody more in the startup area and starting a new business and what that entails.
John, back to the questions.
Yeah, that's all I can find right now.
Okay. Well, about half of our audience would be in a startup mode. And we determined that a business plan with believable projections is very worthwhile. What about on the credit side here? What about the factors of personal credit figuring in and equity into the deal? Do you want to comment on that?
Yeah. As a bank, are we talking, if we're talking straight up startup, we do want to see some cash into the game. Typically anywhere between 10-15% if we're going SBA. Traditionally, it all depends on what kind of collateral we're looking at for the business. Equipment, if it's new, we can do 100% financing, typically 90% financing on used equipment. Buildings, you're looking at 20% down if it's going to be owner occupied, which that would be the only way it's SBA eligible. But that would be on the traditional side, 20% down. But we do want to see equity into it. We do want to see cash into the deal, as well as we want to make sure that your outside living expenses are going to be covered as well. Perhaps you have another income stream coming in, whether it's a spouse or someone else, or you have a job that you're going to keep, and this is something you're going to start up on the side. And then credit-wise, again, the bank is underwriting your deal as the bank. Credit-wise, typically we want to see somewhere around a 700 credit score. I think SBA wants to see around 650, right? To be eligible.
We don't, starting March 1st, we're not going to score anything anymore. We're really going to leave that up to the banks. We were scoring a few of our, one stream of our approval volume, but we're going to desist doing that. So it really is going to be really up to the banks to make a determination about whether there's a successful credit history. But what I will confirm with what Sean said is that the agency wants lenders to take really good care and to make loans where we feel like there's a really good chance of success. You do not want to go out and get a loan, conventional or SBA, if there's a substantial chance of failure. There is a serious costs if you can't repay a loan. And I would rather spare anyone that. I would rather sort of say we made a mistake and we were too conservative than that we made a mistake and we gave someone funding that they should never have gotten and they weren't successful and then they ended up having to declare bankruptcy or God forbid, have some kind of a federal loss or something like that. So we really want you to be very, very confident. So especially with a startup, the financial projections, the financial strength, the ability to put in a good equity injection are all very important. The one thing that I would emphasize more than anything else is the ability to run the business. And by that, I've been in lending for many years, and I think the key aspect of a startup is, do you have management level experience in a business of the same size and type as you want to start? And, we have many, many entrepreneurs that are inspired by the product. They love coffee. They love being in coffee shops. They're a consumer of coffee shops, and they're really enthusiastic about them. But they don't know what it means to get up at 5 a.m. to go in to open the shop and clean off the graffiti from the window and start getting orders in and managing their supply of coffee beans and cleaning the bathrooms. That's what running a coffee shop is. And until you tell me you've done that, I'm gonna have a real tough time saying, "Hey, this makes sense," even if the rest of the numbers seem to make sense. So management level experience at a firm of the same size and type, and you really need that if you're going to be confident in your ability to be successful.
Brian, I think you wanted to jump in on that.
No, no, I agree. I mean, that's a relevant experiment or experience is paramount. We get calls all the time now of because it's becoming the next hot thing is for somebody to try and invest in small businesses or buy boring businesses, and people ask about taking money out of the stock market to buy a laundromat or to buy something else, and they don't understand that running a small business is a very active investment. And it's not something that anybody should just be jumping into if they don't understand really what elbow grease it takes to run a small business. So if somebody's inquiring about a business that we have listed, for instance, we need to make sure that they fully understand and have the capabilities to run that business before we'll even share any information about what it truly is with them.
Brian,
Because
you
yeah,
brought up
that's more important than anything.
franchises.
Mhm.
Brought up franchises, and I just want to put it to the group here about dealing with franchises. What do you look for in your trying to finance a franchise?
Well,
Ray, did you want to talk about SBA eligibility there?
Sure. I mean, I think it's the same thing as from a financial perspective, it's the same thing as we look for elsewhere. And I look at franchise as sort of a middle ground between a raw startup where you're just saying, hey, I'm going to go and sell sandwiches, or a business acquisition on the other end where I'm going to buy somebody else's very successful sandwich shop. There's a middle ground where you say, well, I'm going to do a franchise model. So I have some structure and product viability is demonstrated. And there's a cost to all of these. The cheapest would be starting up your own. The most expensive is buying someone else's, and the middle ground is that franchise where you're buying a model, but you're not necessarily buying someone else's goodwill. So I think all three of those an entrepreneur needs to kind of consider. From the SBA's perspective, from our narrow perspective, we do have eyes on franchises, and we want to make sure the franchises fits what we want to see for independent small businesses. So we do have sort of a light oversight that we do on franchises, and we call it the franchise directory. So to be eligible for financial assistance through our programs, your lender would have to make sure that the franchise that you're targeting is duly registered on our directory, and that we've taken a look and that we agree that they're eligible, and that they're not trying to do something that's out of market in terms of their expenses and that sort of thing. So take a look at the franchise directory and see if that helps you out. We do have it publicly posted. You could Google it and take a look and see. There are thousands of different franchises that are on that thing.
Sean, are you glad the franchise directory is back? Man.
Every little bit helps,
Yeah,
right?
I mean, it makes it easier as far as knowing that the SBA has kind of scrubbed that list, and they know that those franchises, how they're ran, and that their financials are typically in line with what's needed or is what's looked at. So I think the franchise directory is not a bad thing, to be honest.
Well, if a client wants to do a franchise that's not on the list, then they're out of luck, correct?
I don't think that's quite true. They would have to go to the franchisor and ask them to be put on the list.
Yeah,
And I don't
we've
think we
had that happen.
refuse. Yeah, I don't think we refuse franchises unless there's something truly egregious going on. And we'll from time to time we'll see something, right? It'll be like somebody who discriminates against a certain gender, or has discriminatory hiring practices that are against the law, and we'll say, well, we can't do this one. But for the most part, we really are not trying to provide a recommendation. We're not saying this franchise is good, that franchise that's not on the directory is bad. But still, it's another data point that just kind of helps. But if you identify a franchise that you want to work with, and you want to, you've taken a look at their franchise offering circular, and it makes sense to you, and they're not on the directory, then contact them and ask them to get themselves on the directory, and that will just help their eligibility case if their lender does go to SBA for financing.
Yeah, sometimes it's as simple as the franchisor just hasn't applied to be on that list.
Yeah.
Which, again, we've ran into that, and it was a franchise that was headquartered out of Pittsburgh, and they agreed to get on to the franchise list, and we were able to get the several deals done for them.
And for any of you entrepreneurs out there that are considering the franchise, I really recommend those franchise disclosure documents that are provided by the franchisor. Those provide some fascinating information about the success of other franchisees in different areas, what their failure rates have been. So it's really, really good reading to take a look at that. And it'll really inform your financial projections as well, because you can kind of see what their standard model is. At least they used to, back when I was reviewing them, have some really nice sort of standard financials that they would look at, and that can kind of help you inform what your projection should be, looking like. Very helpful.
John, do we have any new questions?
Yeah, I got a couple questions here. This person currently has an SBA loan. And he asks, is it possible to keep the loan if one partner wants to buy out the other business partner?
Yeah. What kind of loan is it? There are different kinds of SBA loans. So usually it's going to be one of the 7A loans that, like, for example, my agency would just guarantee that a bank like Sean's would have made. So you can have servicing actions like that where you change owners, but you have to get the lender's consent. So that could be the bank if it's a bank deal that's guaranteed by the SBA. If it's one of our COVID idle loans where we made a ton of direct loans during the pandemic, if you want to change ownership, again, there's a servicing action that needs to be approved by the SBA if you're going to change ownership. A lot of times a change of ownership actually goes a little beyond that. Usually there's someone asking to be released from obligation, and that could require potential consideration to your lender, whether that's Sean's bank, or whether that's SBA if it's a direct loan from the SBA. So it's definitely not something you want to do without consulting with your lender and seeing what the process would be. But there's certainly nothing against the law to sell a portion of your business or to buy out a partner, or just to quit claim half of your shares to your partner or something. So there's lots of things you can do, and it can be done. Just consult with the lender first. Fair?
Great. So another question said, do banks go by personal credit history for business loans for a startup, even though everything is filed under an EIN number for the business?
Yes, we are going to look at you personally as well, because you'll be what we call a guarantor of the debt, meaning that you're personally signing on that debt. So yes, we do a complete credit history on the individuals that are going to be running the business as well. The way you look at it is you are the business. Small businesses are ran by the individuals that back it. So the simple answer to that is yes, we will be looking at your personal credit history.
Okay.
I've had some entrepreneurs reach out and say, well, I'm going to get a business loan or a business credit card, and I'll keep that paid as agreed, and then I'll let my personal credit go into default. I'm like,
Don't do
man, I don't think that makes a ton of sense. Like, I get it that business credit is out there, and there are organizations like Dun & Bradstreet that really focus on business credit. But I'm telling you, most lenders are looking really hard at your personal credit. Now, one exception might be ECDI, the micro lender that we referenced earlier, which is a great source of support for micro businesses. They are going to take a look at your credit, but they're not going to really be focused on that as much maybe as a bank or a credit union would be. So, Sean mentioned 700 credit earlier, and I know that's a relatively high bar, but I am definitely here to tell you, if you coach your personal credit score up to 700, it unlocks opportunities for your business. That seems a little weird to say, but I think any lender you're going to talk to will say, hey, have strong personal credit, pay your bills every month, and you're going to get yourself in a position where your business has better access to capital because of it.
Your credit's a reflection on you, quite honestly. And that reflection carries over to your business and how it's going to be ran. That's just a straightforward answer on that.
Hey,
So that's
Sean,
why.
broadly speaking, what's the range of credit scores?
I mean, you mean from the lowest to the highest?
Right.
I
Yeah.
mean, your
Broadly.
credit score can go all the way up over 800s. I mean, I think the highest I've seen recently was like 825, 830. So that's a very strong credit score. Um, Lows I've seen them in the 400s, which is not good. Just being honest, I would say anything below 650, we're probably just gonna, unless there's reason behind it, which sometimes there's medical collections that people don't know about.
Sure.
There was a $45 bill that never arrived at your doorstep and you never
Sure.
knew that was being collected upon. So there are ways to look at it and say, okay, well, this was actually he's paying his mortgage, he's paying his car, he's paying all of this, but then there was some lien put out there on his credit for a medical something, or uh, maybe there's a collection out there that they didn't even know about.
I'll
So
share I'll share a little story if I can. I've also seen situations where people have had perfect credit and their business is showing absolutely no capacity.
right,
And that's also not good. So
right,
all the pieces have to fit. I had one guy that was like, yeah, 850 credit. I'm perfect. I should be able to get a loan, no problem. And I looked at his business and it was like showing losses every single year. Well, what was happening was he was not showing his revenue to Uncle Sam for the purpose of paying his taxes. And it's not just a case where we're looking at personal credit. We're looking at the business, we're looking at the personal side through personal credit. All the pieces have to fit. And if they do, then you tend to get a loan. Um, so it's really making sure that you've got that balance or that art, if you will, of making your business look good.
Brian, did you want to chime in?
No, I think you touched on something really important, especially at tax time. Expenses, expensing everything and buying things at the end of a tax period just to pay less taxes can be very detrimental to either getting a loan or the valuation of your business on the profitability side, because you're going to show less profit, which is going to hurt your chances of lending, and it's going to hurt your the valuation of your business.
Have you had any success in being able to explain that to lenders in your business, Brian? Like if someone is accelerating expenses into the current period, are you
You could
able to
do,
go to someone like Sean and say, "Hey, look, this is what I did," and you can see in the next month my expenses
everything.
went way
Yeah,
down, or
yeah,
does that
yeah.
not work at all?
Yeah. I mean, you can only do so much. I mean, everything's
Yeah,
right.
documented. The Lamborghini on a roofing company. I mean, that really isn't necessary. You can explain, that one as a possibility. But I mean, there's and properties that don't belong in the business. I mean, there are some add backs, but the messier it gets, the worse it gets as a
the
deal as
worse it
well.
looks.
And
Yeah,
exactly. So if you just run, I mean, if you document everything correctly for a couple of years before you're looking to sell, then you'll have a much higher valuation and a much better chance of passing due diligence without a discount in the end.
yeah. This is what I tell people. I'm like, you deserve the Lamborghini. You should get the Lamborghini. I love the Lamborghini, but getting a
It's not a
Lamborghini right
business
before you go
expense.
for a business loan is a bad idea. Like,
Right.
don't do it. Stay nice and lean, stay nice and tight. If you know your business is going to be looking for funding,
Yeah.
get lean and don't make those extra purchases that you don't have to,
Yeah.
especially the Lamborghini.
Yeah, just last week I had somebody give me a call, and their big sales pitch to me is, of course, this is a tax deductible as a business expense, and my comment was, if you're trying to sell me something for my business,
Yeah,
it better be tax deductible as a business expense. But if that's your only pitch, that you're taking out of the profitability of my business to sell me something for my business, then we have much better, much bigger things to talk about, because again,
yeah,
you're taking from the profitability and the cash flow of the business, which I know how that affects the valuation of my business and my ability to get loans, and people need to
yeah.
consider that.
Yeah,
John, do we have any other questions?
just a follow up to the personal credit history. Um, so, and they're concerned about if the business fails, then are they personally reliable for the loan?
Yes, that's part of being the guarantor. Um, so if the business fails, The bank's going to start foreclosure action. Once we start that, we're going to go after the assets of the business. We're going to try to liquidate those if it is guaranteed by SBA. Everyone thinks that when we say we have a 50% or 75% guarantee, that's on the full dollar amount that they borrowed. It is not. It's on after we liquidate as a bank.
Yeah.
So we'll try to go after, if there is an SBA, we'll try to go after the SBA guarantee to kick in after we've liquidated. But yes, we will go after personal assets as well if your business does fail. And a lot of times, just as a heads up, if you are applying for an SBA loan and it's at a certain threshold on the 7A program, and we are severely lacking collateral, and you have equity in properties that you own personally or in the business name, we will go after and tag those for mortgages as well, if there's equity available in there. So you're looking at possibly, foreclosure on your personal residence as well, or any other investment real estate you may have out there in your name.
So what is the current cash requirement for a down payment for a loan? Is it 15 or 20%?
If you're looking at an SBA deal, it's a minimum of 10% is what we look at. 5% can come from like a seller's note, but we do require another 5% of it as a cash injection. And then again, it all depends on the collateral that's being provided. If you're looking for an equipment loan, we'll do 100% financing on that, 1-to-1. If it's used, we'll do 90%. If it's a special use property, we probably want 15% down on there. And there's a list of special use properties out there. I'm not going to get into all of them right now. Funeral homes fall into special use property. So, but that cash injection question is going to be heavily reliant upon what you're trying to accomplish and do.
The SBA is specifically going to require a minimal 10% equity injection for startups and for business acquisitions. But otherwise, we're going to let the lenders sort of take the lead on that. But I think just remembering 10% minimum and the more the better is just a good place to be, because it's tough to find lenders that'll do 100% financing unless it's a manufacturer and they've already got a big manufacturing base. That's, I think, what consumers, or what Sean was talking about there, where you could do 100% financing in a lot of circumstances. But again, just a simple rule of thumb for the audience, like try to have 10% of your project in cash before you go to a lender, because it's just going to make things a lot easier if you're not going to a lender saying, hey, I have $1 million project, and oh, by the way, I need $1 million from you. It's much better if you could say, I've already raised some equity on this.
And you're going to need working capital too.
Yeah.
I mean, so you're going to have, bring some money to the table and have working capital consideration. So even if it's not the 10% that you're considering, make sure that you do have some money to bring to the table regardless. When we're doing like internal buyouts and things like that, sometimes that 10%, requirement might be maybe waived. However, again, you have to keep in mind that you do need to have some capital to bring to the table. You're not going to have it all.
So does a high credit rating increase the probability of being able to get a loan, even though you may not have the minimum requirement of cash?
I think that goes back to Ray's point, where you have to look at the business and your personal credit and a holistic picture of what's going on. That's the best way to put it.
Yep.
Yeah,
we look at a lot of different stuff.
Picture.
And sure, if someone has great credit and they've got great income, but they don't have cash to put into it, I guess the question that I would ask as an underwriter is, well, why? What happened there? What'd you spend the money on? And you could have a very good answer. Well, we just bought a home, and look at the equity in my home. And I'm like, oh, I see. Okay, you've got lots of equity in your home. I see what happened. This all makes sense. But if the answer is, yeah, I go to Vegas every weekend, that's maybe a bad answer. So all the pieces end up fitting together. If you've got great credit, you've got good income, then where'd the cash go? And let's have a conversation and see where we go. We want to make sure that when you get that business loan, that you're successful. to the greatest extent we can. So just have that conversation with the lending specialist.
Is there any kind of time limit if are approved for a line of credit? Is there any kind of time limit on using that money?
Depends if it's traditional or an SBA Express, which is what Ray was talking about earlier, the Express program. If you're on an Express program, your revolving portion of that line is out there for 5 years. After 5 years, the bank will either look at and say, all right, you've built up this business. You've had this for 5 years. You've properly utilized the line. It's paying down. It's going up, back and forth. They can move that and convert it into a traditional bank line of credit, which then can be used at any time. But if it's not, then the SBA and your bank will term it out over a 5-year period, whatever balance is on that line. So if at the end of 5 years, you had that $100,000 line that we used as an example earlier, you bought a bunch of inventory, or maybe you paid other items out of it, and there's still a balance on there and it's never really revolved, then it's going to term out for a 5-year period with principal and interest payments.
Are there any specific requirements to get a line of credit and the dollar value associated with it?
Well, so the parameters on your line of credit, typically what I look at is 10% of your revenues, but it all depends on industry as well. That's kind of a standard number that a lot of people look at. But again, it comes down to what are we collateralizing the line with. So if we're looking at your inventory and we're looking at your account receivables, especially, we're going to adjust that dollar amount based on what's out there for us to collateralize it against. And typically your lines are short-term working capital needs. So buying inventory, covering those receivables until you get them in. So when we're looking at receivables, anything from 0 to 60 days, we're going to say we'll give you 75% of that number. Anything 60 to 90, we're going to give you 50% of whatever that number is. And then anything that's over 90 days, we completely discount that to 0 because that might not be something you're going to be able to collect upon. So that's kind of how we figure out. We also do what's called a gap analysis, which I probably shouldn't get into here, but that's basically what your working capital needs are versus what you're already utilizing in cash and so forth.
Another SBA related question on SBA loans. Does the repayment start immediately, or is there any type of grace period?
Yeah, I mean, I think the lender can structure that. Has consumers done some like interest only periods, for example? Yeah,
we do them all the time.
Yeah. Okay.
So if you have a startup and, or let's say it's a new sub shop and you have to go in and you're buying equipment, you're doing leasehold improvements. So basically what we call it is a draw to term loan with the SBA. You tell us, hey, it's going to take me 6 months to build this storefront out, get my people up and running, and start getting sales in. I typically build in a 6 to 12 month interest only period to get the business up and running, start getting cash flow coming in, and then you start your principal and interest payments.
And you can get an approval and then not close the loan for a period of time too. I think you've got years, at least from the SBA perspective, probably not the bank perspective, but it's not like you get an approval and then like immediately that next month you get hit by the full amount. Like you wait until you close, and you could also probably do installment drawdowns and things like that to make it make sense.
Yeah. So we'll do interest on. So let's say you have a project that's a $500,000 project. We're doing a $500,000 loan. Day one, the balance is 0. And then you start making what we would call draws for, again, if it's equipment, leasehold improvements, whatever it may be, your marketing, so forth and so on, capital needs. Then once we hit that final dollar amount, you say, hey, I'm going to open my store. The new I'll just use Jimmy John's because I've done a few of those. New Jimmy John's is opening. Um, we'll give you a few months to get the sandwiches out the door and basically start earning some revenue and making a profit. And then that's when we'll flip it into the principal and interest. But you would only be paying interest during that time frame up there on what you utilize out of that 500,000. So if you've only drawn 100,000, your monthly payment's going to be based on what you've utilized on an interest basis.
Okay.
Yeah, can SBA guarantee loans for leasehold improvements?
Yes, ton of them. That's one of the reasons to utilize the SBA, is collateral, because on a leasehold improvement, a lot of times the bank is not going to be able to go in there and take down what you've put into someone else's building. There is the landlord waiver, just as something to mention. So if you are leasing space and you are doing improvements, the land owner who you're renting off of will need to sign a leasehold agreement, basically allowing the bank to go in and get their hands on whatever it is that we can take out there, whether it's equipment, anything that's not affixed to the walls, basically, or the floor.
I got a kind of interesting question, I think. How does one get a loan that their business is really based on people? So it sounds like they own a counseling service, and all the projects that they have are based on people. So are there any special criteria that this person can use to go out and get a loan to support the business?
I'm not sure I
So it
understood the
sounds like
question. Yeah.
if they have a counseling service, I'm assuming then they're probably billing. Again, that would go back to account receivables. We would take a look at the account receivables. It might be that they're billing Medicare, Medicaid. They might be billing private insurance, and there's a time frame where they're looking to cover that gap of when they receive those payments back in. So yes, there would be that probably would fall on a line of credit, typically. Unless they're trying to add people as far as counselors, then that would be a different discussion.
Mark, that's all the questions I got right now.
Well, the subject of insurance came up, and Brian, have you done any insurance deals where you're selling agencies?
Yeah, we have.
And Ray, what is SBA's stance on insurance agency sales?
As far as like a business acquisition for an insurance
Right.
agent, yeah, it's
Yeah.
fine. We're not going to make a loan for an insurance company itself, and that's like one of the things written into the code, so people get kind of confused about that. But if you're an insurance agent, like you're a State Farm agent or whatever, and you've got a practice, I don't think that's a problem. It can be a challenge, as I understand it. It's not like I'm doing this every day, but it can be a challenge sometimes to get good financial statements from the agents, just depending on the relationship with the insurance company. So, like they have to be an independent and have their
Yeah.
own financials and that kind of thing. So if they're just more or less an employee of an insurance company,
That's different.
that's not an eligible business. Does that
Right.
make sense? Or
Yeah,
Okay,
we've done
so-
we've done farmers, we've done all state agencies where they're independent business owners and they own their book and people have bought their books. And I believe they've used financing, they've used SBA lending for those.
Yeah, we've done them.
Yep.
Mm-hmm.
there's some other questions in the Q&A that we haven't gotten to. It doesn't look like.
Does
Um,
SBA ever call a loan if the business
Yeah.
revenue begins to decline?
I was looking at that. We number one, many and many of our loans they're going through banks, and so the bank would be making a decision about calling a loan versus on revenue decline. It's very unlikely that the SBA would actually be doing like a purchase or like paying off a bank just based on a revenue decline. But your lender might want to talk to you about the revenue decline if they notice that and try and, work with you to address the situation before it becomes critical. SBA, like if we have a direct loan with somebody, like a disaster loan, we're not going to call a loan based on a revenue decline. We might go to default on a loan if you stop paying your bills. Sean, did you want to talk about how you guys look at deals and if there's weakness there, what do you do? And
Well, yeah, if there's weakness there, we try to work with the client, find out what's going on in the numbers, what's happening in the industry. Just because there's revenue decline doesn't mean that they're not making their bills or paying their loans. Quite honestly, if there is an SBA guarantee on there, we're not. I don't think we cannot call the loan unless it's, I want to say, 90 days delinquent past due. And then that's when we would really start unraveling it per se and go to the SBA for our guarantee. But the SBA doesn't call our notes. As Ray said, we would be the ones making that call. Banks, we do love putting covenants out there. Of debt service coverage ratios, so forth. I think I mentioned earlier the 1.2. If we start seeing it deteriorate underneath that 1.2, you really need to sit down with your banker ahead of time and let them know, hey, this is what's going on. The more upfront and honest you are about, the less likely the bank's going to call that note on you. And rather, they might try to work with you or find a situation that works for both parties.
Hey, Sean, this is Mark. How often do you expect financial statements from your borrowers? What's the rule of thumb there?
All depends on the dollar amounts, Mark. The higher you're getting in aggregate loan exposure with us, for example, with consumers, anything, we're trying to bump this a little bit, but anything 500,000 and over in exposure with us, we're going to ask for annual financial statements. So that means tax returns, personal financial statements, both, and then personal tax returns as well. If you're looking at, say, a larger line of credit, we might be asking for quarterly. If there's, if it's tied to the account receivables and the inventory, so we call that a borrowing baseline, just making sure that the assets are there for us to put the money out there to you. But a typical is I would say you're typically looking at getting annual financial statements on and providing those. If there's a deterioration in those numbers, as we just talked about, you're probably going to be looking at quarterly or semi-annual, providing them to the bank just so until everything's healed.
If you're talking quarterly or semi-annually, internally produced is okay, or should it be accountant prepared?
Again, depends on the dollar amount, Mark, and what you're looking at. Accountant prepared is always, preferred, but a lot of times, and with most of our clients, it's an internally prepared profit and loss statement, balance sheet.
Sounds good. John, any other questions?
Well, I don't know whether any of the panels can have any insight on non-traditional funding, like grants and crowdfunding, angel investors.
yeah, I mean, there are you can check out grants.gov. That's a real place that you can take a look and see what might be out there. Traditionally, the SBA itself makes grants to service providers like the small business development centers, the Veterans Business Opportunity Center, that kind of thing, rather than business grants themselves. Look into your local state and local government as far as more incentive financing. As the National Economic Development Group, we don't like pick and choose which regions are better than others, but you might be able to find one municipality that offers a really, really good financing benefit, a grant, or maybe a low interest loan based on you're creating jobs in their area. Jobs Ohio has some grants available, for small businesses. The state of Ohio has some really great, low interest rate programs. As far as sort of non-traditional funds like loans and that kind of thing, ECDI, the Economic Community Development Institute, our microlender has quite a bit of that kind of money. But in terms of like Kickstarter or GoFundMe or Indiegogo, there's all kinds of different opportunities for crowdfunding under different models. It all kind of has that commonality of being able to harness the customers and your relationships to help provide small amounts of capital. I guess I would just say that I think that's great, and I think there's some opportunities there. Just make sure you kind of understand what the obligations are when you get that kind of funding, whether you've got a note with the investor or whether they're just literally giving you their money in exchange for a higher seat at the bar. And we definitely have had businesses that have taken advantage of that. I think it's significant. But we, of course, would need to know like what the obligation is on that funding, if any, and make sure that you could use it for the project that we've got contemplated.
Just want to make sure you put your email and contact information in the chat so that folks in the audience can get in touch with you subsequently. And John, do we have any other questions, or do we have closing comments from our panelists?
There's one here that it says they sold a couple of businesses and have been looking for a new business to purchase. Keep track of biz, buy, sell, and some of the brokers. And it goes on to say good ways to keep away from business for sale. And I see Brian put a comment in there. You'd like to take a stab at that.
Yeah, so I mean, there's thousands and thousands and thousands of businesses on Biz Buy Sell, and independent people posting, their own businesses on there. There's real estate agents that post, and independent people that post businesses. Biz Buy Sell is going to be the largest, probably a posting site for people posting things. There's also, I think there's a Biz Scout, and there's another number of websites where people post and brokers post, listings for sale. All the time. If you want to know kind of what's out there otherwise, you can always look in the area, and you can contact a broker to keep an eye out. There's also lists that you can get on to kind of look for specific types of business. But relevant to this conversation that we're having today, you want to find something that's going to be relevant to your work experience. And what you're exactly looking for. So rather than just kind of broadly looking for what's out there, there may be a perfect opportunity that may not be on one of those websites. And if you work with somebody that might find the perfect opportunity by working with a professional, or that they can just direct you to something that they have. So I would call around, and I would check some resources here in the area. Could also contact a SCORE mentor, but just realize that Biz Buy Sell is the Craigslist of business listings, and that's what you're going to get.
Brian, is that B-I-Z, Biz Buy Sell?
Yeah, BIZBUYSELL. I list businesses on there, and other things as well. Like I said, it's the elephant in the room. They have the largest listings, and people independently list as well, but just be careful.
Right.
Okay, no more questions out there right now, Mark.
Very good. Well, I guess we're at the end, and I'd like to thank the audience for attending, and I'd like to thank our panelists for having the insights and wisdom that they do. And again, they've put their contact information in the chat, so feel free to subsequently contact them with any questions you may have. So again, thank you. And shall we close it out, John?
Yep, sounds good. Thanks everybody for attending. And again, just everyone that's attended will receive a link so you can go back and review this at a later time if you'd like. So again, have a great rest of your day, everybody.
Thanks.
Thanks, everyone.
See ya. Thank you.